So good morning, good afternoon, or good evening, depending on where you are joining us around the world. I'm Jose Luis de Aro with the Communications Department here at the International Monetary Fund. And we are gathered here today for this virtual press briefing to introduce the latest World Economic Outlook update. Title, Global Economy, Tenuous Resilience amid persistent uncertainty. So if you haven't got a copy of the latest WEO update, I would recommend you to go to imf.org. There, as usually, you're gonna be able to download the document, but also you will find other assets that probably will help you with your reporting. And what's best that to talk about the latest update, that to be here joined today by Pierre-Olivier Guinches. He's the Economic Counselor and the Director of the Research Department. Next to him are Petia Cueva-Brooks, Deputy Director of the Research Department. And last but not least, Denise Egan. She's Division Chief, also with the Research Department. Before we begin, let me clarify a little bit for those who are not familiar with the World Economic Outlook cycle, how this works. We publish two full World Economic Outlooks over the year, one in April during our spring meetings and another one in October during our annual meetings. In the interim, we publish two updates, one in January and the one that we are launching today in July. Those updates include, obviously, our new global outlook, the risks to that outlook, and our policy recommendations. But the set of countries that we update are more limited than in our regular World Economic Outlooks in April and in October. So keep that in mind. Let me stop here, and as usual, we're gonna start with Pierre-Olivier's opening remarks. Pierre-Olivier, the floor is yours.
Thank you, Jose. Global trade developments continue to shape the outlook. Following an unprecedented escalation in tariffs imposed on the rest of the world in April, the United States partly reversed course, pausing the higher tariffs for most of its trading partners. This and the de-escalation of trade tensions with China in May modestly reduced the US effective tariff rate from 24% to about 17%. Despite these welcome developments, tariffs remain historically high and global policy remains highly uncertain, with only a few countries having reached fully fleshed out trade agreements. This modest decline in trade tensions, however fragile, has contributed to the resilience of the global economy so far. A few other developments have also helped. First, concerns about future tariffs led to a strong surge in exports to the US in the first quarter of the year. This front-loading helped support activity in Europe and Asia. Second, financial conditions improved and monetary conditions eased as global inflation continues to recede, largely unchanged from our previous projections. Third, the dollar has depreciated by roughly 8% since January. As we already pointed out in April, the effect of tariffs on exchange rates can be complex. In previous episodes, the tariffing country saw its currency appreciate, buffering the impact of the tariffs. This time around, however, the dollar depreciation has amplified the impact of the tariff shock on other countries' competitiveness. With a stable value relative to the US dollar, the Chinese RMB has tracked the dollar, while the euro has appreciated significantly. Accordingly, we have revised our growth projections upwards from the April 2025 reference forecast from 2.8% to 3% this year, and from 3% to 3.1% next year. Most regions are experiencing modest growth upgrades this year and next. This resilience is welcome, but it is also tenuous. While the trade shock could turn out to be less severe than initially feared, it is still sizable, and evidence is mounting that it is hurting the global economy. For instance, compared to our pre-April 2nd forecast, global growth is revised downwards by 0.2 percentage point this year. And at around 3%, global growth remains disappointingly below pre-COVID average. And we continue to project a persistent decline in global trade as a share of output, despite the recent front-loading, from 57% in 2024 to 53% in 2030. risks to the scenario remain firmly to the downside. The current trade environment remains precarious. Tariffs could well reset at much higher levels once the pause expires on August 1st, or if existing deals unravel. If this were the case, model-based simulations suggest global output could be 0.3% lower in 2026. Without comprehensive agreements, the ongoing trade uncertainty could increasingly weigh on investment and activity. Further, while exports front-loading has supported global activity so far, firms could become vulnerable if the demand for stockpiled goods does not materialize. The geopolitical environment also remains fragile, with the potential for more negative supply disruptions. While global inflation continues to decline, the latest price data suggests that inflation pressures are building gradually in the US. Overall, US import prices in dollars have remained largely unchanged or even increased this year, suggesting that the cost of tariffs will be borne by US retailers and importers, and eventually customers, as firms start to pass through higher costs into their prices. In too many countries, the combination of high public debt and still elevated public deficits continues to be a cause for concern. The lack of fiscal space makes these countries especially vulnerable to a sudden tightening in financial conditions that increase term premium. Such tightening becomes even more likely if central bank independence, a cornerstone of macroeconomic, monetary, and financial stability, is undermined. Turning to policies, our recommendations continue to call for prudence and the need for improved collaboration. Let me outline some key priorities. First and foremost, restoring stability in trade policy is essential to reduce policy uncertainty. We urge all parties to settle trade disputes and agree on clear and predictable frameworks. Collective efforts should be made to restore and improve the global trading system. The need for predictable and stable rules extend to other areas of policymaking. It is important to reaffirm and preserve the principle of central bank independence. The evidence is overwhelming that independent central banks, with a narrow mandate to pursue price and economic stability, are essential to anchoring inflation expectations. That central banks around the world achieved a successful soft landing despite the recent surge in inflation owes a great deal to their independence and hard-earned credibility. Restoring fiscal space remains a priority for many countries. Even where new spending needs are emerging, efforts must be made to implement gradual and credible consolidation while protecting growth. Lastly, as global growth remains tepid, more efforts must be made to increase long-term productivity through structural reforms. Thank you.
Thank you, Pierre-Olivier. And let's start this trip around the world. But before we start, let me remind some ground rules. The first one, if you want to ask a question, please raise your virtual hand. Wait until we call on you. If we do, please identify yourself and the outlet that you represent. And try to be concise so we can take as many questions as possible. Also, I want to remind that we have received already a couple of questions through our press center, and I will be asking those questions to Pierre-Olivier, Petty, and Denise on the reporters' behalf. Third point, as I already stated, the WEO update only include a limited number of country updates. So go to the table 1 annex in the World Economic Outlook update, and if your country is not included there, then you can reach out to us bilaterally and we will put you in touch with the teams to get updates on those particular countries. And last but not least, we're here to discuss the World Economic Outlook update. So basically, those questions regarding IMF country programs, negotiations, or even institutional topics are not for this press briefing, but we are happy to put you in touch with my colleagues at the media and social media division, and they will try to put you in touch with the right team. With this said, we're going to start here online. I see Andrea Shalau, Webex, Reuters. Please go ahead.
Yeah, hello. Thanks so much for doing this. Pierre-Olivier, you talked about the need for comprehensive trade agreements. So I'm speaking to you from Scotland. President Trump just signed an agreement with the European Union that takes care of a large chunk of the global economy. And I'm wondering, if you can just walk us through what you think the impact is, knowing that you locked in the numbers before this deal and also the trade agreement with Japan were completed. And then if I could just ask you to sort of zoom out a little bit, if more, this shock that you're talking about is sort of being cemented now at a higher level. Do you think that, we could see tariffs that go, there will be some tariffs that will be higher? Are you expecting to have to revise the outlook again if we see a lot of tariffs that are above the 17%? Thanks.
Thank you, Andrea. So yes, we of course, since we finalized our projection rounds, a number of trade deals have been announced, or the outline of trade deals have been announced with Japan, or more recently with the EU. Now we are looking carefully at the details, and they are not finalized yet. So of course, this is a situation that is evolving. But what we can see, broadly speaking, at this point, is that these trade deals will land the effective tariff rate that, for instance, the US has on other regions of the world in a close vicinity of what we are assuming in our current baseline, our July WEO update. So to be confirmed, but right now we are not seeing a major change compared to the effective tariff rate that the US is imposing on other countries. As I mentioned in my opening remarks, the effective tariff rate is in that update around 17%. Where it will land after we incorporate those deals might be a little bit above, a little bit below, we don't know quite yet, but it won't be very different. So from that perspective, our baseline projections remain very much how we would see the world as of today, as opposed to as of, let's say, 10 days ago. Now, on the one aspect of the trade deals, which of course is going to be important going forward, is whether it brings a certain amount of certainty to the trade environment. And that is also something that very much will take a little bit of time to assess, because we'll have to see whether these deals are sticking, whether they're unraveled, whether they are followed by other changes in trade policy. So the situation is still very much in a state of flux.
Okay, so we're going to keep moving. I see more people on WebEx. Stephanie, please go ahead.
Hi, thanks for taking my question. I also wanted to ask about the trade deals that are coming in and about essentially how much progress on trade deals you think we need to see to actually bring about the uncertainty or alleviate the uncertainty that we're seeing.
Well, as I answered in the previous question, I think here we will have to see how things are unfolding. Again, where we are right now is in an environment where tariffs are not majorly changed from where we estimate them for our WEO update. So we are seeing a slight uptick in global growth to 3% this year relative to April, when in April we're expecting much higher tariffs imposed by the US on the rest of the world, and also some retaliation by some countries like China. So we're in an environment where this is not as elevated, but it remains a level of tariffs that we haven't seen in a very long time, and that is weighing down on global activity. And that's why when we compare to where we were before April, growth is actually revised downwards. Now, the uncertainty, again, is something that will take a little bit of time to see whether the different parties are sticking to the agreements, how the details are fleshed out. These are very high-level deals that have been announced at this point, and so a lot of work is going to have to go into filling in the blanks.
Okay, let's see who I see now. I see Beiji, AFP. Please come in. Hello, Beiji. Can you hear us? Okay, Beiji, I think that we cannot hear you right now. So if you want to send your question through the press center, I'm happy to formulate that question on your behalf. And speaking of the press center, we already received a couple of questions since this press briefing started. And I'm going to formulate one on behalf of We're Yeah from China Business Network. Basically, it goes as follows. IMF has significantly raised China's growth projection by 0.8 percentage points this year. Could you share your thoughts on the sustainability of China's current growth momentum?
Yes, and China's growth is indeed raised from 4%, which was the level we were projecting back in April, to 4.8%. So it's a 0.8 percentage point upward revision for China. It's the largest in the set of countries that we have. And so this is coming in part from a very strong first quarter that we see for China's economic activity. With a particularly important component, which was the strength of exports from China to other parts of the world, the Euro area, Asia, and other countries. And then going forward, one of the component of this upward revision for China is indeed the fact that the level of tariff that China was expected to face back in April, when, if you remember, we had tariff rates that were extremely elevated for China and the US, has been reduced after the announcement of an agreement in May between the US and China. And the expectation that this level of tariff will remain at a lower level is certainly supporting China's economic activity going forward. But now, having said that, domestic demand in China remains relatively weak, relatively low. That's something that we've been flagging for a while. This is something that is a source of concern for the continued growth performance for the Chinese economy. And we're expecting that in 2026, growth will actually slow down even further. We're projecting about 4.2% growth in 2026.
Okay, we are going back to WebEx, and I think I see Shu. Please come in.
Hi, thank you very much. Thank you very much, Jose. My question is on US dollars depreciation. You mentioned that US dollar depreciation was one of the key factors of upward revisions of global growth rate. And my question is it a longer term trend or a temporary one? What is your analysis on that point? And my second question is on BOJ monetary policy. Given the stagnated growth rate in Japan, as you expected, could BOJ have a chance to hike its interest rate, even the gradual pace as you expected? Thank you.
Yeah, so first on the dollar depreciation, it's been one of the important developments in the last 3 months since our last projections. As I mentioned, the expectation at the time of the tariff announcement, in line with what economic theory would suggest, but also, and perhaps even more importantly, with what the empirical evidence also supported, we and many others expected to see some strength in the dollar going forward. We've seen the opposite, and so it's a significant development. The way we think about this depreciation of the dollar, it's a broad depreciation of the dollar against most other currencies, with perhaps the exception of a few, including China, whose currency has remained more or less stable in relation to the US dollar. So it's a broad depreciation of the dollar. That broad depreciation seems to be coming in part from adjustment in global investors' attitudes towards dollar risk. And what we see in particular is an increase in the demand for protection against the risk that the dollar could depreciate further in the future, and that in itself is also helping depreciate the dollar on the spot markets. So that's a development that is somewhat unrelated to what we've seen coming from the imposition of the tariffs. Now, the second part of your question about Japan and monetary policy by the Bank of Japan. So what we're seeing in Japan is a modest upgrade to economic activity in 2025, a 0.1 percentage point increase in growth to 0.7%. So that's a small pickup here, again, coming in part from the fact that there is a lower level of tariffs as seen now compared to April, and that's helping and going to help and support growth in the Japanese economy. We, at the same time, have seen quite a bit of pickup in inflation. Both headline inflation, but also core inflation have been pushing higher. Headline inflation is expected to be at 3.3% this year in Japan. That is temporary. Some of this headline inflation is related to things like the increase in the price of processed foods or rice, and that is expected to be temporary and go away. But in this environment of inflation above central bank targets for some time now, the expectation is that the Bank of Japan will continue to gradually raise interest rates to bring inflation back to target sometime in the course of towards the end of next year.
Okay, I received Beiji's question online, so I'm gonna, it goes as follows. What is the global economy's ability to absorb the price shocks from tariffs, which appear to be settling at significantly higher levels even with deals? Are you expecting more of a one-off impact, and what are the risks to the long term? Thank you.
Yes, so the way we approach the tariff shock is to think separately about the countries that are imposing the tariff, and so at this point it's mostly the US, and the countries that are on the receiving end of the tariffs, and at this point it's mostly the rest of the world. So in the country that increases tariffs, the tariff acts as a negative supply shock. What it does is that it will increase production costs for domestic US firms that have to source a lot of intermediate inputs from abroad, and these intermediate inputs are now facing tariffs that are going to be more expensive, and that is going to raise their production costs. So this is a negative supply shock for the US economy. It's going to reduce activity, and gradually it will also translate into higher prices. We're starting to see signs of this higher prices coming through, and we expect that this will continue, and we expect that there will be stronger inflation pressures in the second half of the year and lower activity. In the rest of the world, it's the opposite. The tariffs that are imposed on the countries reduces the demand for the goods that they are selling in the US. That's a negative demand shock that will reduce activity, but also lower price pressure. Now that's sort of where we expect things to eventually settle. In the first quarter of the year, what we've seen, something that has been blurring the picture a bit, is we've seen a huge amount of trade and exports front-loading. We've seen a surge of exports from European countries, from a number of Asian countries to the US, trying to beat the tariff, trying to get there before the tariffs would be in place. And of course, that has supported activity in those regions. But in the second half of the year and into 2026, there will be payback for this front-loading. There will be expected reduced trade and activity coming from that side.
Okay. Before we move back to WebEx, and I see all of you, I see Guillermo, I see more people there, I see Noor. I will go back to you. I see Cami too. But I just want to ask another question on behalf of Arul Luis from AINS that goes as follows. What are the key drivers of India's growth performance, and what reforms are needed to sustain this momentum?
Thanks. So I will ask Denise to take that question on India.
Sure, happy to do so. So for India, we have actually quite stable growth. In 2024, the growth outcome was 6.5%, and we project for 2025 6.4, as well as in 2026. And the 6.4 growth rates for this year and next are slight upgrades compared to what we had in April, 0.2 percentage points in 2025 and 0.1 percentage point in 2026. And the reason for this upward revisions to growth is because of the common factor that Pierre-Olivier talked about. The suspension of higher tariff rates basically is the main driver. And on the inflation front, we also had some downward revisions. We're projecting 3.7% in 2025 and 4% in 2026. And that's driven by lower food prices getting in. Now, what has been the driver of this relatively stable growth is the fact that there has been a reform momentum supporting robust consumption growth and a push for public investment. And going forward, we think it's going to be important to keep this momentum going. And to continue the recent good growth performance that we have seen, priorities would include fostering job creation and absorbing excess labor from the agricultural sectors by reskilling labor, by allowing more labor market flexibility. At the same time, continuing to invest in infrastructure and removing trade restrictions. More in the medium term, India needs to continue to invest in education, take a step at land reform, and expand the social safety net, and reduce red tape to allow businesses perform better.
Okay, I'm going back to WebEx, and we are moving from India to the Middle East. I see Noor first, then we will go with Matt, then I also see Mahmoud, and we have a question from Doha on the press center. So Noor, please go ahead.
Thank you so much, Pierre, for taking my question. So the IMF has revised Saudi Arabia's growth outlook upward for both 2025 and 2026, and they attributed this much to the increased oil production. However, if oil prices fail to hold at current levels, to what extent does this upward revision remain valid? Are the non-oil sector factors strong enough to sustain this momentum if prices weaken? And on Egypt, if you allow me, please. So for Egypt, while the 2025 projection was upgraded, the outlook for 2026 was revised down. How much has the recent depreciation of the dollar helped Egypt navigate its economic headwinds, such as inflation, of course, and debt servicing and all the forex pressures? And what are the main factors behind the downward revision for 2026? Thank you.
Okay, before we move, Matt, please come in.
Hey, yeah, it's a similar question to Noor. I was just hoping if you could provide a bit more detail or insight behind your 0.6% percentage point increase for 2025 for Saudi Arabia, which I think was the second biggest among the featured countries after China. So if you could provide a little bit more details on that, that'd be great. Thank you. And then also the 0.2 percentage point increase for 2026 as well, please.
Okay. Any other questions on the Middle East? Focus on Saudi Arabia and Egypt. Please come in. I don't see any more questions. Just before we move, Doha from Al Haram also wants to know what are the key drivers behind lowering Egypt real GDP growth projection.
Thank you, Jose, and thank you for your questions. I will ask my colleague Petya Cueva-Brooks to answer.
Thank you. Let me start with Saudi Arabia, where indeed we have one of the largest upward revisions of 0.6 for 2025. Now we are projecting growth to be 3.6. And we also have a slight upward revision for the 26 number to 3.9. What's behind those upward revisions for this year, it's really the higher oil production, which is in spite of the lower oil prices. And this is linked to the phasing out, the earlier phasing out of the voluntary oil production cuts. We've also seen very strong first quarter of this year, which again is behind part of the upward revision for 2025. But beyond the oil sector, we've also seen fairly robust non-oil growth, as we still have very strong domestic demand, which is linked to the implementation of the Vision 2030 project. So altogether, these factors have underpinned our better than previous assessment of the growth prospects for Saudi Arabia. For Egypt, we do have a slight upward revision for the growth for this year to 4% upward revision of 0.2, which is actually offset by a downgrade in the revision for in the forecast for 2026. We are now expecting it to be 4.1, again downward revision by 0.2. The upward revision for this year, let me start with that. That is linked to just the better than expected data that we had seen over the past months. And that is linked to, again, higher than expected output in the non-oil manufacturing sector, in tourism, as well as in in the telecommunications sector. Now, the downward revision in 26 is mainly due to the delayed implementation of the structural reform agenda. And I'll stop here. Thanks.
Okay, before we move on regions, there are other two questions related to the Middle East, one from Mahmoud and one from Reddy. Please come in really quick so we can move on.
I'm ready from Al Ittihad. So your report has been very silent on GCC region. You just mentioned Saudi Arabia. Of course, you may not be able to provide any figure for UAE, but can you give you a broad outlook for the GCC region as a whole? Or if you can give any figures for UAE economy, it's well.
Any other question? Okay, so as I said at the top of the press briefing, and as you indicated, there are only a limited set of countries included in the update. Maybe Pierre-Olivier or Petya can give you a broad outlook to the MENA region. But again, we are happy to put you in touch with my colleagues bilaterally, and then you can ask that question specifically. But Petya, Pierre-Olivier?
Yeah, I mean, I can speak maybe briefly about the MENA region, again, without necessarily having the details for the GCC. For the MENA region, we are expecting a growth to strengthen this year. We're expecting it to be 3.2%, which is an upward revision by about 0.6 relative to what we had in April. What's behind this is really the upward revisions in Saudi Arabia and Egypt that I just spoke about. More broadly, we're also seeing financial conditions being more supportive than what we had previously expected in April, with sovereign spreads coming down, and also we're also seeing quite a lot of international bond issuance. Again, at the regional level, we see inflation as relatively elevated, but we are expecting it to come down in the coming months and years.
Thank you, Petya. So we're going to go as follows. We're going to go next to Katie. Then we will go with the reporters from Argentina, and then we will go to Kemi. So Katie, please come in.
Hi, thank you. Good afternoon. My question is about the downgrade to the forecast for Russian GDP growth to 0.9% from a previous 1.5%. Are you able to explain some of the reasons behind that downgrade? Thank you.
Yes, I will, again, I will turn this question over to Petya.
Sure. So we are expecting the Russian economy growth to slow down in 2025, and that is very much due to the policy tightening and the lower oil prices. We are expecting growth this year to be 0.9. This, as you mentioned, is 0.6 percentage points lower than what we had previously thought. That downgrade really reflects the timing of growth that we had seen as opposed to what we had expected. So growth was higher in the last quarter of 2024, which is resulting in an upgrade for the forecast for the outturn of 24. But then the other side of that is that then we had lower than expected growth in the first quarter of this year. At the same time, we are also seeing in recent indicators such as retail sales and industrial production, as well as the official monthly GDP numbers, we are seeing relative weakness, which again was fed into this downgrade for 2025.
Okay, so I see a couple of Argentine reporters. I see Guillermo, I see Liliana. So let's start with Guillermo. We will take all the questions on Argentina. So Guillermo, please go ahead.
Yes, good morning, how are you? I have a couple of questions about the report. What are the conditions that allow Argentina to be so far above the Latin America average in terms of growth projections? And what impact has the agreement with the IMF had on this GDP growth for Argentina, these projections, of course?
Liliana, please come in.
Hi, good morning. Thank you for taking my question. My question is why the IMF estimated that Argentina GDP will slow next year, 1 point more or less. Why? What are the reasons that we slow growth? Thank you.
And then Agustin, please come in.
Yes, thank you. And my question is, I understand that this update is focused on GDP projections. Do you have anything additional to say about inflation in Argentina? And what are the risks from the GDP projections for Argentina? Thank you very much.
Okay, these are the Argentina questions. Then we received a couple of questions on Brazil and Mexico, but let's tackle first Argentina, and then we can move on.
Yeah, so let me say a few things on Argentina. So first, our growth projections for this year in 2025 are unchanged from our April projections at 5.5%, and also unchanged for next year at 4.5%. The Argentine economy is experiencing a strong recovery. This is certainly a very welcome development. It's undermined by improvements in confidence, in credit, real wages, and all of that on the back of a very strong disinflation process, a very successful so far disinflation process, with inflation that is expected by the end of this year to be in a range of around 18 to 23%. Annual rate. So that is certainly a very strong background for the Argentine economy, and that strong recovery is really coming after a very challenging year 2024. And that explains a lot of the difference with the rest of the region. So this is the update we have on the Argentine economy. Petya, anything to add on?
No.
Okay, as I said, we have other questions for countries in Latin America. Let's start with Mexico. Yolanda Morales from El Economista. I want to know the outlook for Mexico because I can see that the IMF increased the projection. What's behind this change? Also from Leticia Hernandez, El Financiero, something along those lines. How do you see the outlook for Mexico due to the current environment with tariffs and trade?
So when it comes to Mexico, we are expecting activity to stall this year. Last year we had growth of about 1.4. This year we're expecting it to be 0.2, and then we're expecting it to increase to 1.4 in 2026. We do have an upward revision in that growth rate for this year of 0.5. In spite of the developments on the trade side and the uncertainty and the tight policy, and this is reflecting the better than expected data that we've seen so far. Now, when it comes to the impact of tariffs, it's important to keep in mind that different products are subject to different tariff rates, and here the U.S. MCA goods are exempt from tariffs. So what is affected by the tariffs is the aluminum, steel, and the non-U.S. content in the auto sector and such. So when we put it all together, you see that actually a large proportion of the goods are not subject to tariffs, which has again helped in terms of the overall impact that we see.
Okay, not moving from Latin America, last country, Brazil. We have a question from Lucas De Vida, Valor Económico. What is the impact of U.S. tariffs on Brazil?
Okay. So let me start with just the overall picture for Brazil, which is that after 3 years of remarkable growth, we are seeing some slowdown in the economy. We are expecting growth this year to be 2.3%, which is an upward revision of 0.3, which is related to the very strong outturns that we've seen related to the agricultural production. At the same time, some tariffs are already affecting the Brazilian, already incorporated in this forecast. For instance, as in all other countries, the steel and aluminum products are subject to tariffs and such. So now when it comes to the broader question of the impact of further tariffs that had been put forward, our preliminary assessment is that that would lead to a steeper slowdown in activity than we currently are projecting. The products that are subject, that would be subject to these tariffs constitute about 1.1 to 1.4 percentage points of GDP. And just to give you the background of this, about 11% of exports, of Brazilian exports, go to the US. And as I mentioned, some of them, like steel and aluminum, are already subject to the 50% tariffs, while oil had been exempted. So again, in terms of the overall, the size of that impact would depend on the details. We don't have that yet, but the bottom line is that some of the downside risks that we emphasize in the case of Brazil are very much linked to the possibility of these tariffs being imposed.
Okay, we move again around the world, and Kemi has been waiting very patiently, so please go ahead.
Morning. Thank you very much for taking my question. Can you guys hear me?
Loud and clear.
Okay, thank you very much for taking my question. So if you can provide the latest updates on sub-Saharan Africa. And then I have a specific question. One thing from your report, you mentioned that global inflation shows mixed signal. What do the mixed signal, the global inflation result mean for African nations? The other part of that question is also on high debts for the US, France, and other advanced countries. We're seeing a lot of high debts. What are the near and future impacts of these unsustainable debts on emerging economic and African developing countries? And lastly, in your reports, you mentioned that, in your reports, the report said efforts must be made to restore long-term productivity through structural reform. What are the structural reforms that are your recommendation? We're seeing a lot of AI that coming in, especially in the US, that are having impact on job and productivity. So what are the structural reform that you're talking about in the report? Thank you very much.
Okay, we have a lot of questions, but before we answer those, is there any other question on sub-Saharan Africa, Nigeria, any other question on that regard? Nope. So when we answer the sub-Saharan question, if you can also comment a little bit on South Africa's outlook, because we received a question from Business Report. So we have sub-Saharan Africa, touching on South Africa if possible. Then we have the inflation situation and how this affects Africa, high debt in advanced economies and how this also impact emerging markets, and how do we restore long-term productivity. So many topics to end this press conference. So let's try to tackle one by one.
Yes, thank you. So I will take some of the questions and then turn to Denise to answer some of the others. So let me start with actually the question on debt in advanced economies. It's certainly the case that we've seen a number of countries, a number of advanced economies increasing their debt levels. That was certainly the case for almost everyone during the COVID pandemic. Debt levels came down a little bit after that, but then in a number of countries we see them rising again. These countries have elevated deficits and debt is increasing. That leads to higher debt issuance by Office of Debt Management, and that is contributing to putting pressure on long-term interest rates. So we've seen long-term interest rate rising as the markets have to absorb a higher quantity of debt that is issued by advanced economies. And this in the context in which central banks in many advanced economies are also doing quantitative tightening, meaning that they're reducing their overall holdings of long-term government debt that they had on their balance sheet. So all of this leads to higher long-term interest rate, higher long-term real interest rates around the world. And that is impacting funding conditions in emerging and developing economies who face this funding conditions and have to basically deal with them. So that is adding pressure on the rest of the world. On the Sub-Saharan Africa and South Africa, I will turn it over to Denise.
Thank you, Pierre-Olivier. So generally for Sub-Saharan Africa, what we are seeing is continued subdued growth. We are projecting 4% for this year and 4.3%, so a modest pickup in 2026. These are again, along with the rest of the global picture, slight upward revisions, 0.2 this year and 0.1 percentage point for next year. That said, external conditions, particularly for Sub-Saharan Africa, remain quite challenging. We talked about financial conditions, whether there would be a reset to higher interest rates globally and the tightening of global financial conditions, especially for high debt countries, that would be a risk. But also there are domestic risks for Sub-Saharan African economies. Regional conflicts, social unrest, and climate change are perhaps a few to mention. Now, you asked about structural reforms. Given the challenges Sub-Saharan Africa is facing, this is an important pillar for renewed growth in the region. There's need for broad structural and institutional reforms. And what we mean there is, to give some specific examples, further regional trade integration is one. More investment in infrastructure, transportation is another one. And reform of state-owned enterprises, again, especially in energy sector and transportation sector, are the other priorities. Now, we understand that on the fiscal front, with high debt levels as well, there's need for mobilizing revenues, and that can generate a sense of unfairness and inequity that could create social backlash. And on that front, our advice has been for a design of fiscal reforms that are equitable, that are efficient, and more specifically there, what we have in mind is removing poorly targeted exemptions in the tax code, making use of progressive income taxes much more, and building trust and support as we had covered in detail in our October 2024 report in one of our analytical chapters, by engaging with stakeholders, hearing what they need, improving governance and protecting the vulnerable, and at the same time bundling, sequencing, and pacing different measures to make sure that the most vulnerable in the society are protected. Thank you.
Thank you, Denise. Anything else to add? So if there's nothing else to add, we are about to put to an end this trip around the world. On behalf of Pierre-Olivier, Petia, Denise, the research department, the communication department, we want to thank you for attending this virtual press briefing. If there is any other questions or comments that you have, please don't hesitate to reach out to us at media@imf.org. We hope that you have a wonderful rest of your day, and hopefully we see you in October during our annual meetings. Thank you very much.